Mini-grids play a critical role for the achievement of SDG 7 on the African continent. And over the past few years, we have gone a long way as a sector. However, today we are still not in a position to achieve scale to the degree required for transformational change. This is why the Renewable Energy Performance Platform, funded by the UK government and managed by Camco, in partnership with the Africa Mini-Grid Developers Association, has convened two core groups of stakeholders, developers and financiers, for a frank conversation about the key challenges that are preventing scale and how can we jointly and as individuals address them. We will share some of our thoughts about this day of discussions at the end of this video, myself together with Jessica, the CEO of AMDA. But before we do that, we have asked a few participants at the workshop to share their thoughts on these key challenges and the way forward. Here's what they had to say.
The mini-grid sector across Africa has made really fantastic strides over the last sort of 5 to 10 years. So the Renewable Energy Performance Platform alone has mobilised another £300 million on top of the £100 million of funding that the UK government provided. And that's really transformed the lives of over 1 million people. So we're making really good progress on this, but there's definitely way more work to do to really hit the scale required. When we talk about the single biggest challenge across Africa, I mean, obviously we're talking about a vast continent, comprises a really diverse range of countries and contexts. But I think the single consistent factor across all of those would be the extent of the political challenges around some of these investments, whether that's corruption, insecurity in remote areas, or just a lack of reliable and transparent regulation. So really cracking that, bringing down that political risk and creating a more certain environment is really going to be key to unlocking the scale of investment required.
So this is a super exciting market and we are excited to be investing in it. There are a lot of opportunities, but in this moment, the biggest obstacle we find is the availability of equity capital. And part of why, and specifically corporate equity capital, and part of why that's so important is we need that equity capital to be able to grow, to scale. And that's both scaling our teams and building management teams and execution teams that can deliver on the promise of 100% energy access. And also to be able to invest in projects quickly, agilely. And then lastly, to be able to provide some of the equity support to bring in other forms of capital and very specifically debt.
I would see three main challenges to reach that. The first one is obviously the money and the processes that are related to that. So how do we make sure that we have enough money that is well deployed to reach what is needed to reach actually the SDG 7 and the 100% of connection. The second one is really the partnership with stakeholders. We are in a sector such at the edge of the public and the private sector that we need to put everybody around. So the developer, obviously, the investor, the regulator, the utilities. And I think it makes sense because does it make sense actually to have as much utilities as developer in the long term? So we need planification and we need a long-term vision. And the third one is really sustainability of the project. How do we make sure that the connection and the project are there in 10 or 20 years? And how do we make sure that we do not have stranded assets in the next years?
I think the single main challenge is the right funding. And what do I call the right funding? That's the kind of funding that is appropriate for in terms of cost and in terms of tenor that can match what we're trying to do in creating impact for energy access.
We all know that the basic challenge we have is the challenge of the time frame of closing investment deals with investors and applicants.
Yes, so scale is what we want, right? And we can see that across the continent, the policy framework is evolving. What we consider to be one of the biggest challenges now is fit for purpose, low cost capital for large portfolio development. Like the World Bank predicts, if we must electrify 500 million people through mini-grids, then we must have financing structure that can come into the space to grow scale. So I'm saying that we need to develop mini grids in numbers of 50s and 100s. We need as much subsidies as possible. We need the financing mechanism that is fit for the off-grid market space in Africa. And as these subsidies come in and the financing structure comes in, we're able to scale. And of course, as we scale, we optimize and we benefit from the economies of scale. And then, the subsidies can, gradually ease out as the business then grows.
The key thing is actually bringing equity players to the table. In our sessions today, which have been really vibrant and dynamic, in terms of corporate equity investors in a room filled with investors, there were only a couple that were here for this part of the mini grid conference. And I think it's really about bringing more investors who are confident and comfortable with taking equity risk, and particularly early stage equity risk, into the African market, into rural mini grid development. And I think that bringing more people to the table and having a bigger table is really the biggest thing that we can do.
Developers, funders definitely have a role to play here, but it's really important that has to absolutely be in partnership with the governments across Africa at both national and local level. Because really it's only if the politicians and the governments across Africa really start championing this sector as really key investments that can provide really vital services, that we're really going to see a substantial shift in the investment attraction. So, absolutely funders can then come in with technical assistance to support that, but really this does need to be led across Africa by African governments.
I think there's a lot of partnership that is required for portfolio development. We must no longer see mini grids as ones or twos in different places. We must start looking at mini grids in portfolios, in numbers, multiples of hundreds. If you must electrify, on the investor side, we need low cost capital. Some level of blended finance, finance that is able to take risk, finance that can behave like equity, reimbursable grants, so that we can build a large-scale portfolio. And however, the investors can blend it and structure it specifically, for the mini grid market. On the developer side, then we, the developers, of course, we need to then build massive portfolios. We need to do the project development in parallel as we're raising the finance, so that we can, average out some of this risk. And if possible, even across African countries, we can average out the currency risk, we can average out the demand risk, and so that we present, a portfolio worthy, a financing worthy portfolio to our financiers.
And it's education on the money. It's on the investor side. It's really to educate officer, risk committees, and management on the sector and all the subtlety or the issues of this sector and the specificity of the sector, which is really specific on the business we are doing. The second one is on the partnership, educating the public institution, maybe the public authorities, to make them understand how to have a long-term vision and how the investor and the developer works. And then the last one is obviously on the impact and the sustainability, understanding and educating everybody on where we are going, what are the impacts, what are the real outcomes of this business.
Nigeria, basically the expectation gap between the investor and the investee needs to be closed. There needs to be that synergy of expectation and what is reality, because particularly for the due diligence stage.
Okay, so the developers need to actually get themselves to the stage I call the RTI, which is the ready to invest stage, where they are able to go through all the due diligence of the investors. Then the investors and the funders needs to ensure that the funds that they're providing on grant for us is the right type of funding that have the right cost and the right tenor, as I said earlier.
So do you think today's event has achieved its aims? What are your key sort of, what sticks with you after this day?
Yeah, I mean, I think it's been actually really good. It's the first time in probably 4 years that we've sat down with investors and developers all together in such a like cohesive manner. And I think, you know, the sector has evolved a lot, and I think everyone's thinking about what's missing, what do we need, has changed a lot. And, you know, I think if there are maybe two key takeaways from today is that we need to figure out how to finance and fund the core teams and build the core team capacity. That's going to come before profitability comes. And so we either need to figure out how to leverage in corporate equity into the market or figure out how to use some of the concessional finance to help support building the corporate teams.
The other key thing was about concessional financing,
Yeah.
which we touched upon in different dimensions. One of it is, of course, with regards to viability gap programs.
Yeah.
And everything related to that. So the time where they fit into the overall picture of sort of a funding cycle,
Yeah.
how to make sure the timelines align, and you know all of the issues around that. But also thinking on the investment front. So we spoke a lot about we try to identify a common view of the risks that sort of how we analyze the sector risks, how developers do that, and how investors see that. And I think it's just made it clear that some of the risks can be mitigated, but that will include you know, much more expensive capital, and that will raise the costs. And so there is really a strong role to still for the concessional funders to play there in terms of entering blended finance structures, being that first loss of capital,
Yeah.
and mobilizing the financing from there.
Yeah, and I think the other key piece is that we just have to figure out how to do all this stuff faster. I think one of the, you know, somebody today raised that if we were to meet SDG 7, we need like 12,000 deals to happen at the current deal size in order to be able to achieve just the financing aims to achieve SDG 7. And so we have to figure out how to make the processes work faster and the size of the deals to be larger in order to be able to accelerate that growth, both on the concessional finance side, equity and debt. It's kind of across the board. There's a lot of moving pieces in that, but
No, absolutely. But we came together 1 year ago, I guess, was the start.
Something like that. Almost a year ago.
And decided that we really need this event. We need to bring developers and funders or investors into one room and to try to break down some of the silos in terms of how we look at the key risks and the potential of the sector. And I think we've really succeeded in that. There was a lot of excitement in the room, and it's only the starting point, but we started building some common ground that we can hopefully expand on.
Yeah.